Good morning. Welcome to Traders Workshop. Today, chips and options trading. What does that mean? We're going to talk about Intel, one of the dogs of 2024, and we had a bullish call on it. So let's take a look at that and more after the bell. I found my cowboy hat. I did. It's coming. Good morning, gents. How are you?
This is the only show where there's like three genres of music, one right after the other, just to intro.
What can I say? I should have been a cowboy. Just saying. Hey, by the way, Jason, I'm still waiting for my hat. Did you lose my address? The Ballin something hat.
Yeah, I'll write it down.
Put it in the notes.
All right.
Okay, so I surprised these guys this morning with the Intel call. So let me lay it up for everybody. We are going to show you a strategy that can be used for either a very bullish concept or a very bearish concept, depending on how you set it up. Okay. First requirement is you have to have a reason for being bullish or bearish in the first place. Okay. I can't give you that one, but assuming that you have that reason, we're going to show you something kind of cool. Mark and Jason are going to say, I've got a better idea, but we're going to get to that in a second. All right. So here's the layup. Intel on one of the shows on Friday with Paulina, she kind of highlighted that Intel was just an absolute utter dog. And if we look at the chart, let's go to the charts real quick one time. If you look at the chart, this is a year chart. You can see where this was. Let me put my little cross-hatchy things on here. I should have done that. My bad. Okay. So you can see where this was at the beginning of the year. It bottomed down at $18. So the net value is down about 56% for the year, which is massive. In a year where the Dow did pretty well. Okay. So we can go back. So just so we have that layup, Intel just cratered, right? So what is the reason for the cratering? It got in the competitive space with chips and all that kind of stuff. I think NVIDIA kind of came into the fold. That was a wonder story. Apple's always around there, all those great stocks, and NVIDIA just didn't keep pace. So the basis was, after this Intel disaster, I asked the gals on Friday, I said, are you bullish or bearish? They both said they were bearish. And I said, it makes sense. They suck. I kind of feel bearish myself, or at least, not great about it, until my 11-year-old analyst came to the party and gave me a thumbs up on it. What do you think he said? So this kid's a gamer. Okay. And he said, Mr. Lex, I got news for you. Intel has a great new chip for the graphic card and the gaming world, and it's awesome. It's one of the best that's out there. I'm a big gamer. I use it. It's a deal. It's a big deal. And I think it's overdone, this sell-off. I'm like, okay, I love this. I got a reason to be long. So I'm like, what the hell? An 11-year-old analyst. So this is when the stock was trading. This is several weeks ago. The stock was trading, I want to say, around 18 and change when I did this. Okay. So any ideas on what you think I did besides just get long stock, which I didn't do? Mark, what would you want me to just show you my strategy, or you want to call? No, did not.
I'm just looking at the chart. You nearly bottom ticked this if you were getting in at 18.
100%. And that is not any skill whatsoever. That is absolute luck.
That 11-year-old is giving you liquidity.
Well, that's the luck part. I didn't plan to get on the bottom. I didn't know where the bottom was. I just wanted to get long. Okay. Now, what I tell to all the folks is that when you're trading options, you have the ability to get long safely. If you just buy stock, that is certainly getting long. And it isn't safe because you have downside exposure still, right? So using the options complex, you can create a strategy that gets you long and protects your downside. So let's go to the screen again.
To do a collar?
Nope. All right. Can you guys see this?
Yes.
All right, I don't think I have a drawing tool, but I'm going to use my mouse. Can you see my mouse drawing on here?
Yes.
Okay. So what I like to do is get long synthetic stock. Mark, I'm going to let you explain what that is because I know you know it. I'm not putting you on the spot or anything. What is long synthetic stock for the folks?
So synthetic stock, I guess I would define as using options to replicate, 100 shares of stock. And typically, most effective way to do that would be a combo, which is selling a call and buying a put on the same line.
Other way around.
Synthetic stock.
Other way
or
around.
you can buy a call and sell a put, and that gets you long synthetic stock.
Correct. So I want to get long here. So Mark said it exactly right. So synthetic stock, it's using options to create a stock position. That's why it's called synthetic. Okay. Now, the difference with this is that you can protect the synthetic stock. Okay. If you buy stock, and you can see I have 200 of these things on. So 20,000 shares times at the time it was 18 and change. Let's call it 18 and a half. If I had bought the stock for 18 and a half times 20,000 shares, it would have cost me $370,000. Okay. I just did that little calculation on the computator. All right. So I could go buy the synthetic stock and have a very similar downside problem, right? With the synthetic stock. So I could basically buy, let's say it's trading right at it was at 20. So I got it for, a great price. What I did was I went down 3 strikes to protect it. I figured if it went down another, $3, I was wrong. Uncle, I'm out. Now, notice what I did on the screen. I bought a protective put down $3. So I bought the 17 put. Now, all of a sudden, we have long the 20 call, short the 20 put, which is our synthetic long stock. Okay. It's going to behave just like long stock. But I added the same amount to the 17 put, bought 200 of those, and now I've stopped my position out to the downside at that value. So what does this all become? We've got synthetic long stock with a protective put, or we've got a put spread, okay, a short put spread with an extra long call. So the price I did all of this at, and I wasn't able to compute it, I do it quickly before the show, was 5-cent credit when I did it. Okay. Now, don't forget, I've got $3 of a short put spread, which I did for a 5-cent credit. So I can lose $295 on this whole complex. That was my downside risk. $295 times 200 is $59,000 I could lose. What's my upside potential? Infinity, right? This will go to zero. This spread here, right? I'll make my nickel, but I also have a long call that's built in there. So I'm kind of paying for this thing. And the long call can go up forever, right? And I still have that downside risk. So I did this around, I want to say 18 and a half. And you might ask, well, why the heck did you do the 20 strike when it was trading 18 and a half? Because I was really bullish. So I pushed the long side of it up a little bit and pinch the put down a little bit. Does that make sense? I know I'm talking a lot. I'm gonna let you guys jump in here. What are your thoughts so far?
Well, yeah, that's where I was going to say is that assuming you were at the money and striking your synthetic stock right where we are now, the only cost of this trade should be your put protection.
Correct. 100%.
So essentially you change the credit on this trade, or you could change it to be a debit, obviously the other way. That's right. By adjusting the out of the moneyness to compensate for the value of the put that you were buying.
Correct. And at the time, and again, I don't remember. I should probably have notes in here. Oh, I do have notes. Hold on a second. Let's see the notes. Intel trades 1880. That's where it was when I did it. I made a note to myself, 1880. Okay, when I did this. So I chose just $1.20 above the strike to do this. And it worked out, like I said, it worked out to be about a 5-cent credit, the whole package. Okay. So if it craps out on me, goes to $10, okay, I'm gonna have a 5-cent credit in a put spread, so I'm gonna lose $3 there, and then whatever I had that call on. But don't forget, the call and the put were very similar, right? So you look at it that way. So the whole net thing was a $3 max loss to the downside, less the nickel I collected, right? So that worked out beautifully. Now we've seen the two synthetics that we have on: long call, short put, same strike, synthetic long, or long put, short put, credit spread with extra call attached. Very bullish. Would you guys agree?
Yeah.
Okay. Now let's take a look at where this is now. So you can see on the screen here, I have 200 of these left. We're up. This spread is now trading 211 from that 5-cent credit. Makes sense. Here's the graph of just that spread that I got long. Remember, and at the time it was, these aren't exactly the right numbers. I couldn't get them in there before the show, but I got close enough. So I can lose this $60,000 number-ish. That's about what it was. And here's infinity, right? Keeps going up. So I've captured a good bit of this P&L. And to the point of the difference between 5-cent credit and 210. So I'm up 215 on this thing, right?
Mm-hmm.
So terrific. It worked. It was safe. Start getting out. Now, another note, look at the percent of my P&L, 4,300% gain. If I just done the stock trade, okay, buying the stock and seeing where it is, it's about $3 move on about 1880 thereabouts. So that is what? I'll say 1850. That's a 16% gain by just buying the stock, right? So, if you're into the percent game, this is a much better do, much safer, way safer. You can do way more of it. I'm guessing most folks can't do 20,000 shares, but you can certainly do, maybe you could do a 200 live. So what? You pick your size, but you can absolutely do more doing the options trade. Any comments on that? Thoughts?
I'd argue that 4,300% is a little disingenuous. Like the arithmetic is the same as if I understand
100%.
that, but like to argue that you earn 4,300% on a nickel is, I don't think that's the right extrapolation.
You certainly did, but it's still the same dollar amount, right? So I think sometimes when people say there's so much convexity in options, yeah, it's true. You're spending a lot less. The point here, though, is forget about the 43%. Just know that the amount of money you expend using options, if you do this intelligently and well, versus what you can make is way, way better deal than just buying outright the underlying.
So, I mean, in most brokerages, and I believe Tradier is one of them, if you would have just bought the stock and then bought the puts to cover the stock, you would have the same outcome.
You could, yeah.
The margin outcome
is
too.
still
No. That's not true. That's not true in retail trading. The reason it's not true is because unless you're a portfolio margin customer, you don't get comparative on long stock, long puts, which we know is a synthetic long call. They margin the stock independently and the put independently. If you have portfolio margin, which requires 250 in your account, okay, 250,000. Then they look at that as a synthetic long call and margin it as much.
Okay.
So for you smaller traders, again, you're not going to do 200. I get it. You can do 50, 110, whatever. You have a lot of leverage using a trade like this. And Mark said earlier, okay, if you're bearish, you can flip this over and do it the other way, meaning you could sell the call, buy the put. Now you're short a naked call. You've got to buy an upside call to protect that, right? It's just the opposite flip. Now that's a big downside side, and all the graphs are going to be reversed. Okay. Now, there's a lot of gibberish. Tell me what you guys would have done with just a flat out bullish play. Now, you guys could say, I want to do a call, a debit spread. I want to sell a put spread. I think that's all good. I just wanted the unlimited upside, and I'm not even out of this. I sold 50 of these. I'm going to sell another 50 at $3. I'm going to wait till the 11-year-old tells me when to get out of this thing.
Oh, the 11-year-old will never tell you to get out.
He's going to tell me keep it forever, right?
Yeah. Okay. So there's a couple things here. Number one is you do realize you're in earnings time, right? Like earnings is next week.
Yes. So I should get out?
Well, that's the next question. Like, is this something that you think that, I mean, you saw that chart. You can go back to the chart. I mean,
oh, yeah, sorry.
There's very few earnings days here where it went up. And I'm looking at, our good friend Matt Amberson's platform at Orats.
Yep.
One time out of the last 5 earnings reports did Intel fall within its expected move. Its expected move this time is 9.2%. Last time they missed earnings they were expecting a negative 2-cent earnings, and they got negative 46. And obviously, earnings fundamentally is a crapshoot. It seems like if you're taking your advice from an 11-year-old, it's a crapshoot, right? So
I feel good about it.
Although they jumped on that negative report, you're talking about the October 31st.
Yeah,
They
it
reported
jumped.
bad earnings and then they jumped 10%.
Yeah, the real bad earnings was that August 24th one. But
Correct.
yeah, so I think the market doesn't always know what to expect from Intel. However, according to Volland, there's a bullish
Well, that's what I wanted
kind
your
of look
take on
on
this.
Intel. Up
Yeah,
to
I wanted the
30.
Volland take on this too, Jason. Sorry to interrupt, but yeah, I definitely wanted to hear your take on where all this gamma and Von and Charm lie.
Yeah, so the big strike to pay attention to is 30 on Intel.
Okay, that's way out there, but okay.
It's way up there.
Oh, out there. I'm way out there, but
yeah, yeah. The 30 or the 25 strike has a lot for this week. So it looks like
would that be, in your opinion, and this is only your opinion, would the 25 strike be sticky? Is that kind of a buffer zone maybe? Because if you look at the 25 strike on my chart here, you can see my little cursor. So that's about where this little bit of resistance is of late. You know, I know we had all this from way back when, but you got a little bit of stuff going on here. So it makes sense that maybe there's some stickiness up at the 25 strike.
The 25 does look like it would be a sticky strike. If earnings are very good, then I think it would rise up to 25.
Right.
As far as the downside, though, first of all, there's no institutional put buying on this. I mean, very little.
Okay.
So I think they believe that the downside is exhausted. So you might win out on this one.
So this is a really important point for people watching, right? This is a combination of, first of all, an opinion. That's all it was. Someone had an opinion of being long or short. Okay. I'm not going to argue with anyone as to why they get long or short. Okay. I hope it's intelligent, good reasons, which is wonderful. That's number one. Number two, if you can go to Jason's product and figure out where that stickiness and where that support could be relative to dealer positioning, also helpful in your decision, right? Thirdly, call up Mark and ask him and become one of his customers and say, what the heck should I be doing? Or do it for me if you want to sign up with Mark, because I want to get long here safely. And I want to use options because I want to maximize, my ability to make money here, right? So these are all good ideas and good things. This, to me, for getting just straight out badass long or short, I love this play a lot. Now you could say, why don't you do a call credit spread, a ratio credit spread? Okay, let's see it. I love that too. That's not a bad idea, especially on a big giant move. I love that. That's also infinity to the upside, right? Mark, any thoughts on any of these plays? Do you like anything specific, or you like this one sort of, or not so much?
So I was going to ask you if you consider overwriting a call against this as like a way to like juice the trade a little bit, collect a little bit more premium. Like I think that's one way. And at that point, you're sort of starting to alter it into the ratio spreads that you describe, right? So I would tend to like that. I tend to prefer on a short-term play. I don't like the unlimited, right? Because to me, unlimited is a decade-long play. That's a theory of Intel's going to rebound over the medium to long term. Like I want that unlimited upside on my medium to long term equities. Yep. Whereas when I'm playing in the short term in options, I tend to want to sell something against it on the upside, really define that spread with a little bit more bounds, because I think that's the more likely range of outcomes here. Right?
Okay, so love the answer. Okay, let me ask you a question now. So if I did this trade, let's say one of our viewers did this trade, again, forget about the size, 1 lot, 10 lot, doesn't matter. And they're at this point of the game. Would you recommend, again, this is just, just a thought, it's not investment advice. What about selling one of these upside calls? Because remember, you're long a naked call in this equation. Now you can use that income strategy with this spread, and all it becomes now is synthetic long stock, long put, short call, which is a collar. And you just use the synthetic part to create your collar. Now you can keep rolling this out until March of, which is 57 days away. You can keep doing this month in and month out, or week in and week out, however the expirations fall. I love that idea. I think that's great, right?
This is sort of what I would call like an equity swap, where you're short a put spread, long a call spread, and you're trading. We talked about this in DJT back in August, right? Like when you get really funky skew, you get insane risk rewards in some of these trades. Right. Intel, I imagine it's going to be a little more vanilla, like the skews, maybe a tad bit to the upside. But in that context, you can really frame the trade. Like unlimited's a really hard number to imagine, right? Like infinity plus a nickel is still a nickel, or it's still infinity.
Right.
But like the idea of saying I can lose $300 on this to make $500 on the upside, and I paid a dime for that.
Sure.
Like, I think that's like an easier trade to grasp in the.
Yeah, that's 100% right. So the point I would tell folks is this. When I did this thing, I'm not thinking infinity either. I know that's not realistic. I'm thinking that, what is realistic in terms of a rebound. Jason had a great answer at 25 for obvious, technical Volin type reasons. Maybe that's the place you start getting out. I already got out of 50 of these things, right? So I'm not looking at this forever. I'm looking out to make a great return. The kid was right. Okay. Now, is he right infinitely? No, of course not. So right now, I think the great thought process is, do I get out? Do I sell the call? Do I take some off? What is the answer? My thought is I'm taking some of this off, put it in the bank. It's been great, right? I put out another 50 lot of $3. You can see it right here. So, I'm going to scale out of this a little bit. I don't disagree with selling a call against this and holding on a little bit if you have a longer term horizon with this thing, and you're still pretty bullish, right? Now, bullish doesn't mean going back to 50 necessarily. Maybe it means going back to 25. So I don't mind that short call play here, and now have a synthetic collar on of sorts, right? So maybe you do a little both. You take some off, put a little collar on. At some point, you can sell a $3 call, and now you have it locked in, right? Yeah. If it keeps moving up.
So what was your prop? I mean, I guess you're relying on the 11-year-old for your exit strategy.
I relied for the entry strategy. Why not hit the parlay?
So I think the other thing too is, for me, $61,000 of risk to make, yes, you can make infinity, but what are you realistically trying to target? If you're trying to target 25, okay, but especially with the way I'm going to use a fancy word, kurtosis is, and the upside here, you could probably risk a lot less to make, the same profits.
100%. Yeah, I can move my long put, and make and risk a lot less. He might have froze.
Well, you can either move your long put, or you can just do a call debit spread. I mean, like,
you can do that 100%
because of how if you did a 24-25 back when it was 18, right? But right now you could even look. That's only like 25 cents. That's that's 300%. And sure. I know you had your 4,800%, but I agree with Mark on the calculation of that.
Yeah, and in this kind of trade right here, though, this is probably for someone who has a little bit longer horizon. I only did 57. You can always roll this out, right? So this person who did this might be looking at a 30 handle to get out of this. Now, don't forget, if it gets up there, I can move this put. I can roll this put up to above this. So all of a sudden now I have the long put spread, and now I've done something very different on this thing. If the pricing is correct, at some point I'm going to get a cheap enough price to move this put up, and now I have a play to the downside where I lock that in too. So there's all kinds of little hijinks you can do with this thing to make it really cool. Assuming you're right, you can kind of play a double whammy on it, right?
Yeah.
But I do, again, we're thinking about 60,000. It's a big trade. Think about a one lot. It's $300 versus what, maybe a 1,500 to the upside, 1,000.
Yeah, but let's say you do a one lot though, and you're looking for it. Even you're looking longer term. You could widen the spread a little bit. With $300, you can do a at the time you're 18, you could do a 20-25 spread, and right now that's $200. And you can make and that's all you're risking.
Sure.
Yeah. You know what I mean? So I mean, even if you did the one lot, make $300.
I agree with that. I think in the world of a small rebound move, I like that play better probably. In the world of a big, huge play, I like this one a lot too. Both work very, very well.
Yeah, and I mean it's a good play. I like it.
Yeah, and that's cool.
Like the advantage of using options is that you have, there's optionality. And when you do synthetic longs and shorts, you lose that, that's, and that's kind of, that when I'm doing my option trades, I always try to leverage. I see options as a tool, as a Swiss Army knife. I mean, with an equity, it's a hammer. You're either buying or selling, selling. You're in the front of the hammer or the back. That's it.
Yep. Good point.
But with options, there's so many different ways to use them. The short gamma, long gamma, short vega, long vega. That you can refine your thesis so much that this is a fun play. I agree with it. I think with the way you're managing it, it's good. I just prefer the ability to lower the risk and create some of that optionality that
Sure.
like that gamma that options can deliver.
Yeah, I know we're getting late here, but what we can look at in another show is that spread that you just said, and maybe a 2x1. Mark, do you like doing those, like where you have a ratioed upside? And if you can get those 2x1s a little bit out of the money for credits, now you have no risk to the downside, right? You got a little risk in between the strikes and at the strike, the long, but we can still hit the home run. Again, that's probably a play like this where it's a little bit more of an explosive, distant move to the upside, rebound, as opposed to just cracking through a debit spread short leg up top. So, but yeah, the point of the matter is lots of choices using options, I think, right? And that's why we love them so much.
Yeah. I mean, one thing that I, kind of on that note, I see a lot of retail traders that just buy puts and just buy calls. And I mean, there are times in which something like that is good and that it will work. Yeah. But most of the time when you're doing that, you're just going to lose. Like those options are priced for that liquidity.
No, I think that's right. I agree with that.
And that's, but so when we do this show, when you see something like a synthetic long with a protective put, that kind of thing, it just, shows that options are a Swiss Army knife. And, you could always sit there and use the screwdriver. Even when the knife is required, you still can't, you can't do the same thing with that screwdriver. So learn your options if you're going to options trade.
Yeah, absolutely. I think it's couldn't have said it better myself. I love it. I love the idea. Mark, any last parting words? What can we advertise?
Don't take financial advice from an 11-year-old, even if it makes you money.
I'm so happy with this kid. I'm like, I'm not a gamer. I don't know how to do that stuff. But I love when that world chimes in. I'm like, 11-year-old, I'm in.
I love it. I love that he's into the markets. I think that's fantastic.
Yeah. I'm waiting for my phone call or my text from him. Lex, get the hell out. It's over. Done.
I hope you're buying him a new console.
It'll be in 7 days after the earnings are over. He's gonna be like, "Oh, they blew up. It's over."
Yeah, that could be another story. Speaking of earnings, the Netflix earnings were yesterday. We could probably get to those down the road. Although I wish we had done that one, because that one had an expected move about 8%, I think, and overnight it was like 13, 14. Blew it out, but I think it settled back into a nice spot. And Mark, you know what I did? How am I doing? What was it?
You double time spread?
Yeah. Did I mess it up?
Strangle swap?
I did a double. I did a double time spread. Double calendar. Netflix, and I'm like, oh, this is gonna work. But actually, the stock sold off a little bit during the day. Got down near my short strike. So that spread expanded a little bit. I actually had some positive money in it. I think I might have gotten out though. I got to figure that out. I'll figure it out. Anywho, all right, guys, good show, fun.
Well, next week we got way bigger earnings than Netflix.
Well, let's pick one. What's coming out? Do we know?
And then we have FOMC and.
Oh my God. Okay, so hold on. So next week is Thursday, right? I'm looking real quick before we go. Anything big? I want some really good ones. Oh, Tesla on the 29th. So we're on Thursday the 30th. Hey, by the way, just so you know, 30th is my birthday. Don't forget to say happy birthday. Okay.
I'll get you a Volland hat for your birthday.
Give me a Volland hat for my birthday. All right. But the 29th, Tesla, Microsoft, Meta, all after the close, IBM, big day.
Apple,
if someone wants to type in the chat what stock they want us to talk about, or all of the above, that'd be wonderful. Before the open on the 30th, when we're speaking, nothing really fun, but MasterCard, CAT, UPS. I'm not looking at I like the tech ones because they move a lot. After the closing, Apple and Intel. Oh, Intel, you said that already. Love it. Oh, we got all kinds of stuff. I got things to do next week.
Yeah.
Love it.
That's a change of pace.
Wow, shocker, right? All right, guys. Awesome. Good talking to you. Have a great rest of the week and weekend. I know I will be starting wine consumption later tonight. I had a damp January. It's been very good. I'm very proud of myself. But
so
Derek asked us before we go,
February thing you do?
Let me show this question. Which one has the least expected price move?
That is somebody who wants to buy options.
I don't know. Well, I like it, or maybe sell options if the least expected move. Who knows? So Derek, what we're gonna do is this is a great question.
Yeah,
let us look at it because there's too many to analyze. Okay, so we'll do expected move in dollars and in percent based on the price of that underlying stock. And what I like to say for this is go to the earnings month. Okay, just as a little tidbit, and look at the money straddle. This is not exactly the science and mathematics of the expected move, but it's close enough. Mark, chime in if you want, but add the call and the put of the money straddle. Let's say it's $4, right? Divide by the stock price. That's the percent move expected roughly. The $4 is also the dollar move that these market makers are expecting. Not exact. There's a fancy formula that does that, but this is close enough. Drop the grenade, get close, and you should be fine. And Derek says he's generally a seller. I like it, Derek. You're speaking my language. Very good.
The only simple adjustment you can make is if you adjust by like intrinsic value, to the extent like if you're trading SPY and there's a strike every dollar, not worth your time. If you're in Apple or something and you're right in between a 250 strike, that might actually make a difference on a $7 straddle.
Yeah, exactly. But yeah, it's a good little thumbnail. When real quickly when Netflix had its straddle, looked at that straddle, it was like $72. Okay, so that, and I think that equated, and again, this is from memory, that was like an 8-ish% move they're expecting. It moved 13.8%, $126 overnight. Now I know it settled down at toward the end, but that was a pretty big move, and they obviously killed it. Let's see. I'm going to put this up here for you. Derek's talking to us again. Give me a second. I priced the in the money put and call and the at the money put and call and divide by 2. Mark, I think that's up your alley. Can you respond to that one?
I guess I don't quite know what in the money, what deltas.
I think he's talking about like the surrounding options closest to the current price.
Yeah, I tend to be with Lex that like the straddle's your hammer, right? Like that's a pretty good indicator. And like, honestly, where it's not a good indicator probably means the name's too illiquid anyway to trade.
Yeah, that's true. But don't forget these. Look at just so folks know, this market making community. Okay, they're pretty savvy at pricing this stuff in. Okay, they're pretty good at this. Now, are they sometimes wrong? Well, Netflix technically, you'd argue they were a little wrong on that one. It got blown out a little bit, but they're pretty sharp at this.
Well, they're only wrong if they're wrong across 1,000 different instances of this, right?
Right.
Of course, not every single one's going to be perfectly right.
No, not at all. And they build in probably a little value primo to protect themselves, right? So.
Well, I mean, the benefit of earnings is like for most names, it's 5x's, 10x's the average daily volume, right? So like even if you're wearing a little bit more risk, you've been collecting significantly more edge to fund that.
Right. That's right. Very good. All right, we'll take a look next week. It's going to be earnings show on Thursday, the 30th, my birthday. And we will cover the big ones, I think. We're Tesla for sure, Microsoft Meta, those are all fun. And I'm going to show all my calendar spreads I'm going to do. I'm going to have them all on.
I'm going to have one. I have 1 week to make enough old jokes to count for your birthday.
Don't worry. Okay. I could probably still beat you in a race, just so we're clear.
In a race?
Ooh,
what? Wheelchairs?
No, wheelchairs. Oh my God. You guys funny. All right, we got to go, boys. Have a great weekend, rest of the day, yada, yada. Hang around after. We'll see you next week on Traders Workshop and have an awesome weekend. Hasta la vista.
Happy trading.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.